Welcome to Horizon Investments fourth quarter review and 2020 outlook. I'm the president and CEO of Horizon Investments, Robbie Cannon. I'm joined by our chief investment officer, Scott Ladner, as well as one of our head analysts, Austin Fitch. Thank you so much for joining us. Today, we had a wonderful 2019. We'll talk about the investor in a second. I just want to thank you personally for the partnership that you've created with Horizon. It was a tremendous year for us, and we look forward to seeing you in the new year. Today, we're going to cover a number of things. Certainly, we're going to cover markets. We're going to talk about risks and briefly about the planning cycle. Obviously, as a goals-based investment manager, I want to highlight that our frame of reference is different and unique in that it's the individual at the center, not the institution. And so we derive the conversation from that conversation that we have with the individual in terms of the questions that they're trying to ask, like how do I grow wealth? How do I preserve or protect it? And how do I not run out of it? So when we talk about the markets, we talk about risks, we're thinking about those questions and how to answer them. One of the most readily asked questions to us and probably to you is this the right time to invest? And so as we talk about the markets, we certainly want to keep that in mind. So as we talk about the topics today, specifically, we're going to talk about cycle, and this is economic cycle. We're going to talk about the case for and against this idea of late cycle investing. Certainly, we're going to have to address risks, and then we'll talk about the planning case and certainly take your questions at the end of this. So, Scott, as we approach 2020, we do have to look back and say 2019 was a pretty phenomenal year to be an investor, whether you're looking to grow wealth, preserve it, or fund some sort of retirement goal.
Yeah, no doubt, Robbie. I mean, just thinking back on what people felt like and what the outlook was in December 2018, it was pretty bleak. We were coming off a really rough December, a really rough fourth quarter, but the market did what it typically does do, and it did climb this proverbial wall of worry, and actually had a stellar year this year, rewarding investors that were able to look through some of the noise from the fourth quarter that was really driven by some positioning and some other really technical factors that we highlighted in our piece last year. But we're really looking forward to another great year in 2020. So look forward to talking with everybody about it.
Well, what's interesting about what you're saying is you're looking out even in 2020 and saying it's not over, but that begs the question, well, what is over? And so that certainly leads us to this discussion of late cycle investing, or at least a conversation topic that is all over the investment industry right now. And we want to address this by first asking the question, what is an economic cycle? And while as surprising as that basic question might seem, there's a lot of individuals that graduated business school in the last 10 years that have never seen a business cycle, have never seen a market like '08 or '02. And so it begs repeating that you have this idea of recession, depression, recovery, and expansion. And that's simply the business cycle. But when we talk about this is simply the business cycle, when you actually look at the economic cycle, you're not seeing that over the last 10 years. In fact, this is a historic run, not only for markets, but specifically for economic growth. And there's terms like the new normal to indicate this idea of a slower growth type environment that we've been in for such a long period of time. But really, it's a conversation around how long are we going to wait before a cycle takes back hold, meaning before there's a recession again, or this idea of a depression or a trough. And what I would say is that there's two sides to this. And we're going to break that down today in terms of a case for late cycle, meaning we're at the end of a 10-year run, end of historic run, but we're literally at the end of it, meaning you need to be real careful here, and the side against it, meaning we're not late cycle, we might be in for a longer cycle. And so we'll talk to both Austin and Scott about this. First, as we talk about the case for late cycles. So these are arguments that you're probably going to hear in the marketplace, probably in financial news, Austin, about, hey, you need to be careful here as an investor.
Absolutely. And I think the first one, and this has been one that's been prevalent for quite some time now, is just this idea of central banks around the world and tightening and the picture associated with the rate change that occurred. And again, much of this occurred late in 2018 as we headed into 2019, and really created an environment that was making it difficult from a planning standpoint. It was starting to choke off growth, and I think you start to see that as you look at some of the manufacturing data, where really from a manufacturing standpoint, things were starting to slow down. You're starting to see economies around the world start to really experience weakness for the first time in years. I think the other thing that I would say in regards to what we're hearing and arguments maybe for a late cycle is just this idea of the fact that the markets have been strong for so long. You see the chart here, looking back to the bottom there in 2009, we've had a really strong run off that bottom since 2009. Over 10 years now when markets have really just gone up and to the right. So that has also been an argument, I would say, for us being in a late cycle economy. Couple that with the fact that the trade war that we all experienced during 2019 really didn't add any clarity to the picture. I think more than anything, it just added confusion. And you can see this cycle that we were in specifically around that trade war, where maybe things did happen, didn't happen, but it really just led to an overhang, both from an economy standpoint and from a market standpoint, that created doubt in the investor's mind and really created confusion for the investor as well.
And so when I go to summarize this and the argument for late cycle, Austin, I'm really hearing a few things here. So one, certainly manufacturing is weak, and we've gotten these numbers. We continue to get them that the manufacturing sector is weak. Certainly, you're making an argument for the inertia of the market just in general in terms of it's worn out from this run since '09. And then this consumer investor sentiment argument that there's just a lot of doubt and confusion, whether you're talking about political uncertainty or whether you're talking about the trade dynamics with China. But those are some of the basic arguments that we're hearing.
I think you're absolutely right. I think that the time component is another one that we hear, that it's been so many consecutive quarters that we've been in an expansion. And again, Scott will talk to this around maybe why we don't think that's necessarily the best argument. But those are definitely things that we're hearing on a regular basis.
So as we jump over to you, Scott, I do want to start by highlighting manufacturing data, because that to me is the strongest argument in that the manufacturing data is weak.
Well, no, it has been weak, and it has been declining, for the better part of a couple of years now, in response to a bunch of different things. In response to to a tightening cycle by global central banks, in response to uncertainty surrounding trade issues, in response to some of the inflexibility around sort of European politics and everything else. But regardless, the manufacturing side of the global economy was certainly in decline for much of the last 2 years. But part of the story for the case against this being a late cycle and this being more like a maybe the middle of a longer cycle than we're sort of used to here in the global economy is that the global central banks have started. They did ease. The story of the last half of 2019 was a story of global central banks recognizing some weakness and aggressively easing. And that easing has caused the manufacturing side of the economies to inflect upwards. At least they've stopped decaying, it stopped going down, and now we're starting to inflect up. Because when global central banks ease, and you can see the speed with which they've done the easing on the graph on the upper left, that does have that there is a lagged effect on manufacturing and on general economic activity. There's really going to be a tailwind for most of 2019, for most of 2020 coming through the rest of the year. Additionally, Austin and you guys were talking about some of the effects of the trade concerns and some of the effects of some fiscal headwinds that we saw out of China for much of 2017, 2018. And those, all of those things are starting to be resolved and being resolved in a pro-growth way. So that what we're looking at in this upper left, this upper left graph is a graph that I've shown on quarterly calls in the past what it's looking at is leading economic indicators out of China, United States, and Europe. And China is the one in the gold. And our argument has been for several years now that China is such a large economy now, and their policy swings are so massive that when they swing policy one way or another, either tightening or loosening, it really does drive the global economy on the margin. And so what we saw out of 2019 was a lot of Chinese stimulus, not as kind of sugar high like stimulus as we got in 2015 and 16, but a much more steady dose of stimulus out of China. And we did see Chinese leading economic indicators inflect upwards in the first quarter of 2019. Now, it's not going to be an immediate effect on the rest of the world. It's always a little bit of a lag, 2-3 quarter lag. But we are starting to see evidence now. You can see that the blue line starting to hook up. That's the U.S. leading economic indicators. That we are seeing a turn now, starting in the fourth quarter of 2019, leading economic indicators in the U.S. and it appears to be Europe hooking upwards as well. That is very, very positive and another good tailwind for 2020. The last thing I want to talk about, at least on this slide, is the argument I hear all the time about it's just been so dang long. And it's been long. It's been 10 years. It's been, depending on how you measure it, it's either 6, 7, or 10 years. If you have to recover the previous high or not, to where we are in this bull market cycle. And it feels like a while because we're living in it every day. But if you pull yourself out and you look at the history of the last 75 years or so, these bull cycles can go on for a long time without meaningful corrections. And so just the fact that we've been in one for the way that I measure it is from the previous high for about 7 years now, it doesn't mean that this can go on for longer. These things can go on for quite some time. And so this argument that it's just time or we're just due, really it may feel right, but it does not have any evidence that supports it from a historical standpoint. And the last thing I'll say about the case against a late cycle economy, and really what I think puts a nail in the coffin of the argument that we're in late cycle right now, that we have some sort of recession that's out there, is the strength of the U.S. consumer. The consumer is the thing that has held us up through the manufacturing decline that we did witness and we did experience. The U.S. consumer especially has been incredibly strong this cycle. We're in an economy right now where if you want a job, you got a job. You're getting wage gains. And consumer behavior, as I'm pointing out here, consumer behavior is starkly different than it has been in other sort of economic expansions. Not only do we have savings rates that have actually gone up during this cycle as the consumer has delevered, but we have debt service that's at all-time historic lows. So the consumer from a debt service standpoint, how much of my bill does it take to service my auto debt, my student loan debt, my mortgage, everything else, is at all-time lows right now, and that's starkly different than the consumer behavior we've seen in other past cycles, where the consumers actually levered up as they felt better and better. This time, the consumer's been levering down, and so they're in a great spot from a employment standpoint. They're in a great spot from a wages standpoint. They're in an amazing spot from a leverage standpoint, and their consumer comfort is feeling really good. So all of those things would just argue very strongly against the case that we're actually in a late cycle economy here in the United States and globally.
So this whole conversation, what's interesting from an individual perspective, they're asking the question, is this the right time to invest? And it certainly seems like there's this whole conversation about, no, you need to wait because it's late cycle, or some sort of, hey, this is Fed manipulated growth. I think the conclusion that we're coming to is they're not invested enough.
Well, yeah, look, just the simple statistics about if you invest at all-time highs, what's likely to happen? The most likely thing to happen after an all-time high is another all-time high. And so just the fact that things are going up doesn't mean it's not a good time to invest. And the argument that this is a Fed manipulated market or whatever. Look, this is reality. This is a reality we've been in for over a decade. Global central banks are involved in the economy in ways that they were not previously. So what? Which way is the Fed manipulating the market then? Is it manipulating it up? So you don't want to be invested in a market that you think the Fed is manipulating because they're manipulating it up? That doesn't really hold. That's not a very logical conclusion any way you cut it up. But regardless, we are in a different type of economy than we were in the 80s and in the 90s. And it is one that global central banks are more involved now than they were in the past. That's not necessarily a bad thing, but it is reality.
So it's different this time. Again, it's not necessarily bad or good. It's just different. But there's certainly things that have to keep us up at night. And what we wanted to do after this conversation about late cycle is just say, I'm not sure we're worried about late cycle necessarily. I mean, we kind of think about it being longer, not late, but there are some things that we're watching. Certainly, Austin, um, whether we talk about the election, whether we talk about geopolitics, certainly there's some specific things that we're concerned about.
Yeah, I think the election is a crucial one, especially as we head into 2020. And the chart on the left hand side really gets at maybe where the concern is this idea of a Democratic wave election that could potentially occur. Not to suggest, from a social standpoint, policy is good, bad in either direction. But I think what you're seeing from the Democratic side, and specifically in this case, Elizabeth Warren, is potential tax proposals that are fairly progressive and really would be fairly onerous, both on the individual and the corporation. And I think that's causing some potential concern if that is a possibility. Now, I say that, and I'll caveat it with the fact that more recently you started to see the probability of a Warren election, and really for that matter, even a Warren nomination, it started to fall off. But that is something that we're watching on a regular basis. I think we'll have a much clearer picture as we get later in the quarter. Super Tuesday is the first Tuesday there in March. I think that's something that we'll have a much better idea as that time rolls around. But until then, you're really trying to read through the information that's out there and understand how that affects the portfolio.
It's really interesting from an individual standpoint. I mean, there's all these really good reasons to wait to invest, right? It's never a bad reason. It's just, hey, we're late cycle, right? And I kind of catch that theme, or, hey, I'm going to wait to have some more clarity in regards to the domestic election. We should get more clarity in regards to Super Tuesday, but really most clarity is going to come third quarter and certainly in the mid fourth quarter. And by that time, really 2020 is already in the books. That said, Scott, there are some things unfolding maybe even quicker in terms of geopolitical risk in regards to Iran and certainly North Korea.
Yeah, and geopolitical things are sort of fundamentally unforecastable. They are the sort of the wild cards out there. With respect to the Iran situation, though, specifically, it is not a situation where we believe that a stark escalation is the most likely outcome. It's in neither party's best interest, frankly, to do that. Trump has a well-stated aversion towards prolonged conflicts in the Middle East specifically, and Iran can't possibly hope to win in a war against the United States and have their economy further crippled by sanctions. So we don't think it's actually the most likely scenario that this gets escalated a ton, but it is always a possibility that there could be a policy mistake or mistake by leadership that could lead us in a place that would be troubling. But history, the one thing that we can look at is how did markets perform through other similar types of episodes in the past? And history has smiled upon those that have been able to actually look through and stay invested through episodic things in the Middle East specifically, because they do turn up every now and again. But our idea right now is to really kind of be able to look through conflict in the Middle East, because we don't think the most likely outcome is one that is tremendously bad.
So Austin, we've got taxes and this idea of a Warren or Democratic wave election. Certainly, we've got geopolitical risk that we'll watch, and equity valuations, earnings are coming out as well.
Yeah, that's something that we hear on a regular basis. Is much of what we saw from a return perspective in 2019 was really due to a valuation expansion, and you can see that in the chart on the right. Really, the PE expansions that took place and the subsequent return from those equity markets. I think what we're watching for specifically as we get into earnings season this year is there earnings growth actually coming from the companies? And that's something that we want to make sure as we head into 2020 that we continue to see that really drives that next leg higher for the markets.
So as we talk about risk, let's transition now to this idea of a planning cycle. We talked about economic cycle and what that was. We talked about late cycle investing, talked a little bit about risk, but here we're really looking at the wealth curve and and breaking it up in terms of the um, different objectives that an individual might have as they approach one of our advisor clients. And certainly there's this need to grow wealth, this need to preserve it and protect it, and certainly individuals that don't want to run out of it.
Yeah, Robbie, you mentioned earlier this idea of time segmentation or the time component. And I think that's something that's super important to think about from a financial planning perspective, is to understand that time component and how that's associated with the different goals that individual clients are trying to achieve. We talked about accumulation, preservation, distribution, and I think what you know as a planner is that the time piece is different within each stage. And why that's important is because you actually have to, from a portfolio construction standpoint, you have to think about things a little bit differently when that time component changes.
So, it's interesting. We break it down into some examples. One, your kids are headed off to college. Your 529 has been maxed out. You've got enough money there to pay for the hopefully 4 years in college. The question comes: is this the right time to invest? Certainly, it's dependent, right, on what's in front of you. And in that case, we'd say, no, that's probably not an appropriate time to invest in equities. But somebody 20 years out that's looking to fund retirement and looking maybe to distinguish bonds from stocks, how do we think about that same question?
Yeah, I think obviously the longer that you have to invest or to really be in the market, the more equity exposure that you're willing or maybe able to take from a risk perspective. But I think, Robbie, you hit on a great example is as you get closer to maybe taking income off a portfolio, you have to start to think about those portfolios a little bit differently, whether that's some form of risk mitigation as you start to approach the distribution phase, where you're thinking about how do I protect that wealth that I've accumulated over time, or as you get into the phase where you're taking income, whether it's to pay for something like a college education or for that matter to pay for a retirement. In that case, you have to think about the idea of how do I most efficiently use my assets in a way that's going to last for the duration of this distribution period. So I think thinking about the time component within each of these stages is crucial to being able to effectively manage those goals.
So what's really nice is that we take some ethereal concepts like life cycle investing, make it super practical to the investor and to the advisor. And that really is goals-based investing, this idea of bringing product together with planning. But Scott, back to you in regards to markets. It seems like, okay, so equities right now, it seems like fixed income is low, so that also would argue for equities. It seems like the Federal Reserve would argue for equities. Take us through this idea of how we're balancing risk, because we are taking risk when we're investing in equity. So as we're suggesting to a client, is this the right time to invest? Typically, they mean equities. There is risk associated with that. And so it really, we need to be able to balance that opinion.
Yeah, I mean, look, if there is no risk in equities, you get T-bill returns. And so there is always risk associated with investing in equity markets. But in our view, it is best to do so when you feel like you have some tailwinds at your back. And we've highlighted a few of those, I think, today in regards to the global central bank activity. That those cuts being in the kind of being in the can and being a tailwind for basically the entire year. The Chinese stimulus coming out, the known unknowns being resolved in a pro-growth way with respect to both Brexit and the Chinese trade negotiations, and just the fact that everybody thinks the late cycle and everybody's worried about the next thing about the next shoe to drop, and everybody's thinking that a recession is around the corner. Those are the times that actually you get rewarded the most for being invested. But if you do have clients, or if you do think that things are more tenuous than we certainly do here right now, there are different investing strategies and different risk mitigation techniques that you can avail yourself of just to be invested, and maybe not capture the entirety of the upside, but still capture meaningful upside and meaningful gains for your clients, which are a great financial planning tool. Gains are the best financial planning tool out there. and you can't get them without being invested in some way. So if you are still nervous, or your clients are still nervous, and you can't get them over the hump, we would push more towards maybe some of the protection or the spending strategies that do give you still opportunity to access gains in the markets, but in a more risk controlled, more risk defined way.
So thank you, Scott and Austin. So this portion of the call, make sure you're looking at your dashboard, your GoToWebinar dashboard. You certainly, there's a number of you that are asking questions. Please keep asking them. I'm going to ask them of our panel here. First one is this conversation with Trump's tweets. This always comes up, this conversation that is in regards to investing in emerging markets. Last year, obviously, Trump tweeted about China, brought emergings down, specifically China. How do you think about Trump's tweets as it relates to international investing?
Well, it's something where you have to be aware of them, certainly. But Trump tweets for a purpose, and Trump is a very intentional with how he does things. It may not always seem that way, but he certainly is. We saw that with how we dealt with China versus the president of China, in very different types of manners. And it ended up being telling to what the ultimate outcome of the situation with trade was. But it's Trump is going to be there's going to be a lot of bombast. There's going to be a lot of sort of aggressiveness in initial tweets. He does like to play the game that way, but it is something that you do need to kind of look through and ultimately evaluate what are the likely outcomes based on everybody's best interest or the party's best interest involved in a conflict. And in this case, it is fairly clear that the best interest of both parties is to have this, de-escalate in some manner. I'm talking about Iran right now. De-escalate in some manner, but it's something that you certainly have to be watchful because people can still make mistakes.
So Austin, this is for you. It does, interestingly, the context of this question is should we be worried about the Federal Reserve in 2020? What's interesting about that is obviously we were worried about it in 18. It was a tailwind in 19. So good question contextually.
Absolutely. And I think what we would say is no, is the short answer. And I think part of that is that the Fed has been explicitly clear that they understand maybe part of the reason for some of the volatility that we saw in 2018 was due to some of the miscommunication and missteps that we saw there from the Fed. And I think they've done a much better job in 2019 specifically in communicating, and the communication thus far as we head into 2020 would suggest that they are going to stay out of the way for the foreseeable future. And I think that's something that from a certainty standpoint definitely adds some confidence to the investor and gives them a little bit more certainty around making investment decisions.
And maybe what we could say as well is that Chairman Powell is much more seasoned now at the just financial conversation. He perhaps was a little bit more cavalier a couple of years ago. Scott, another question that I think is really important because we're talking about equity investing, we're talking about investing in risk. As you look at rates, specifically low rates, that pushes everybody to look in maybe more risky places in terms of yield. What's your thoughts about where the 10-year rate is going and investing in credit in 2020?
Yeah, I mean, as far as the 10-year rate goes, it's probably around the right price right now. The one of probably the most underappreciated headline or sort of set of headlines that we've gotten over the last 6 months is involved how the Federal Reserve is considering changing their framework for measuring inflation and their framework for how they actually conduct monetary policy. And I won't bore you with the details, but the conclusion is that they would actually they would measure inflation on an average basis, and so that would mean that given the past 10 years worth of inflation misses, we would actually have to have a lot of inflation for the Fed to hike rates. So all that means is that the bar to hike rates is very, very high right here, and I think they've been fairly clear that the bar to lower rates right now, barring some sort of exogenous incident, is actually fairly high as well. And so we're in a place right now where global central banks, had hiked for 9 or 10 months in 18 and cut for the last 6 months, and basically back to unchanged over the last 2 years. And that's a place where we actually, I think, we're gonna have a lot of stability out of central banks for this year. And that is a situation where you don't expect a whole lot of changes in global interest rates, and that would include U.S. rates as well.
So maybe one more question. Certainly, we need to address the question of elevated oil prices, depending on how long they last. I would argue certainly if we have a strong consumer, Scott, and you have elevated oil prices, that's going to act like a tax on the consumer. It can't be a positive for the consumer. But is the consumer strong enough to kind of not worry necessarily about elevated oil prices?
Yeah, oil prices where they are here, or even probably another $10 higher from here, would not present that much of a problem to the consumer. Like we illustrated earlier, kind of where they are in their debt cycle is the consumer is very, very under levered right now, and the job market is fantastic, and they're getting wage gains, so the consumer is in okay shape to weather some tax increase. And historically, you really don't get a big hit to the consumer until you get an oil price spike of somewhere around 50 or 60%, and we're nowhere near that right now. And the more important point, though, is we're probably unlikely to get a spike like that because the oil dynamics globally now are very different than they were 10 years ago. Now the marginal producer of oil in the world is the United States. And so the ability for oil price shocks to actually maintain or sustain in a meaningful way when the United States was not the marginal supplier of oil to the world, it's just a very different dynamic. So now the shale producers in the United States can produce all the oil they want at $60 or $70 a barrel and make a ton of money. And so that acts as an effective cap on how high oil can actually go in the short term.
So Austin, as we go for one last thought here, we've covered late cycle, we've covered elections, we've covered elevated oil prices. Maybe leave us with a closing thought.
Yeah, I think, Robbie, the one thing that I would hit home is, and you've heard rhetoric, both late cycle, mid cycle, we've talked all through all of that. I think, though, probably the most important slide that we went through today, in my opinion, is the planning cycle slide. And the reason I say that is because it's very important from a planning standpoint to understand the time component for the individual client when really creating that individual's financial plan.
So let's leave it with that, Scott, is to say, I think I'm going to guess the most important slide for you was more about the consumer and the health of the consumer.
Yeah, and it continues to be a very underappreciated story. The combination of a strong, robust U.S. consumer with the backdrop of global easing on both on the central bank and the fiscal side is a really powerful combination that we think is going to be a pretty prosperous 2020.
So for Austin Fitch and Scott Ladner, I'm Robbie Cannon. I do want to end it and just thank our partner advisors. And whether you're here for an advisor conference at the home office, whether you're on our tools and our dashboard, and whether we see you throughout the year, thank you so much for your partnership and support. Thank you very much.